Hello everyone, welcome back to my channel. So this will be a different type of video. This is a video in which I've been wanting to do for quite a long time, but of course with many things going on in terms of work commitments and of course my commitment to show you what has been going on in terms of the Road to 200k challenge. I've been postponing, but now it comes a time for me to show a different perspective on the strategy of the wheel strategy, and I just wanted to show the various reasons why I'm using this strategy for the challenge, the Road to 200k challenge, and why this strategy is in the long run a successful one. And as long as you stick with it, and of course you make the correct decisions based on what the strategy dictates, I am a strong believer that you will profit, you will be successful in the long run with this strategy. And so without further ado, let's just start it by saying that of course before that, beyond the strategy itself, the wheel strategy, as I mentioned before, basically you sell put options on stocks. Of course, these will be out of the money puts, meaning that the strike price of the puts are below the strike price or the current stock price. Just to give you an example, for example, in here with SLOD, if I pull up its option chain, the wheel strategy would entail, in this case, to sell, for example, this put right here. This is a short position in a put with a strike price of 90. The current price is 91.66. So these are out of the money puts. All right, these are in the money puts. These are in the money calls, and these are out of the money calls. So the strategy dictates that first and foremost, assuming you have buying power to do so, you sell. So you go to the bid column and you sell puts or out of the money puts on the particular stock that you are interested. And so you keep doing this, and until while the stock price remains above the strike price, nothing happens. The put expires worthless. You keep the premium, the option premium, and you continue to do that over and over and over again. Eventually, it may become a point in which the stock price falls below the strike price of the option, and so the put option becomes in the money. For example, if previously I sold a put on SLOD, for example, which is this stock with a strike price of 93, eventually at this point, if the stock would mature, I would be forced to buy this stock, which is currently 91.66, and I would have to buy the stock at a price of 93 because this is the strike price. And so once you do that, once this happens, you get assigned the shares, then you do the opposite trade. Basically, now you have the shares with you, you use them as collateral, all right, and sell calls on it, and so you receive a premium for being short on a call. For example, let's just say that we want to break even in terms of capital, and we sell a call on SLOD with the same strike with 93. So this call is out of the money, all right, and so we continue to do this all the while the stock price is below the strike of the call. Eventually, when the stock price rises and it goes above the 93, I will be forced to sell the stock at a price of 93. But in the meantime, I've collected some premiums, and so even though I would break even on capital, I would still be profiting because of the premiums that I collected until that point. And so once that happens, I sell the stock, the collateral, I receive the money, of course, the proceeds of the sale, and then I go back into the same pattern. I sell puts again, over and over and over again, until I get assigned, and then sell calls, and over and over again until the shares are sold, and the cycle begins all over again. So that is why the strategy is called the wheel. But with this out of the way, we need first and foremost, and also to understand the strategy and to understand why the strategy is a successful one, let's try to dissect two universal truths about options, which is very, 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 very important for us to understand why this strategy is a correct one and a successful one over the long term. So, two universal truths about options. The first and foremost, and this is an extremely important point to make, is that most options expire worthless. Alright? And so, why is that? Because options, as they say, act as sort of an insurance against adverse price movements. And so, as we well know with our own insurance policies on our car, on our house, on other assets that we have, even though we are using insurance, we know that for the most part, the insurance, we will not file claims on the insurance on a specific event. And why is that? Because if this event would not occur like that, if an insurance would not function like that, then nobody would provide the insurance. And so by selling options, all right, what we are doing basically is providing insurance to the buyer of the options, saying that, all right, if this event happens, in case of the put, the stock price falls below the strike. In case of calls, the stock price goes above the strike. I will be forced to buy the stock at a given strike price, in case of a put, or I will sell you the stock for in case of calls at a particular price, which is the strike price. And so this is the reason why, one of the reasons why selling puts is a successful strategy, because most options expire worthless, and when they expire worthless, nothing happens. You keep the premium for yourself, and the option buyer loses the premium and doesn't get anything in return because nothing has happened. The clause, the underlying clause of the option contract does not verify at maturity, and so nothing happens. And the other universal truth about options is that options, and this is also extremely important, are intrinsically expensive. And why is that? Options are intrinsically expensive, meaning the premium of the option is typically higher for the amount of risk that you are taking in, because if it was not like that, of course, nobody would provide insurance against a negative event. In the same way that when you buy insurance for your car or your house, you would never buy insurance at a fair price. You always pay a price above what is fair, because that provides the let's just say the profit margin for the insurer. The same goes with options. Since the option seller is providing insurance to the buyer, all right, it must have a sort of a risk premium so that he gets compensated for the risk that he's taking, all right, and so because he's providing insurance to the option buyer. And so these two universal truths about options, basically what they do is that these make profitable to be the seller of the options in the long run. All right, some events may happen, of course, but as we well know, insurance companies profit in the long run, even though they have their customers file their claims here and there. We know that in the long run, providing insurance is a profitable business for the insurance companies, and the same reasoning applies to options, and in this case to the option seller. All right, this is a very important point these are very important truths and are very important points to make. Now, another reason why the wheel works is that, and this will require me just doing some drawing, even though I'm a lousy drawer, but the thing is that due to the dynamics and the patterns of payoffs, options are effectively a bet on volatility. So what I mean by this is that, let's just say, for example, that I'm going to draw here. Let me just use a little bit of a, yeah, this is better. All right, a thicker marker. All right, so let's just say that we have, actually, let's do this a little bit different right here. So we have our graph, all right, in which we have, of course, the profit, all right, the profit, all right, and in here we have the strike price, right? And so we know that, for example, a pattern for a long position on a call goes like this, all right? We know that here it's 0, all right? And in the same way, the graph for a long position on a put is like this, right? And so this is a call, all right? And this is a put. Now, the thing is, why is options are a bet on volatility? Because if we want to profit from a stock that is very, very volatile, and so the price moves around a lot, perhaps I should use a different color here, but doesn't matter, right? If the stock price goes like this, it makes sense for us to have a long position on an option, be either a call or a put. And why is that? Because if the stock price ends up in this section, all right, and meaning above the strike price, all right, and the strike price in this case is here, all right, in this spot right here, this is the strike price. In the same way for the put, the strike price is in here, right? So if the stock price for the call, in which we have a long position on a call, ends up in here, we profit. Why? Because we get to buy a stock which is worth, for example, on this side, for example, is worth 100, all right, and for example the strike here was 90, so we buy for 90 a stock that is worth 100. But if the stock, which continues to move like this, ends up, for example, here, all right, in this region, we don't know the price, but for example, it ends up at 70, we are not also that bad, because simply we don't exercise the option, all right, we lost the premium, but we have the option not to buy a stock for 70 by paying 90, so the option expired worthless, we lost the premium, but of course the loss is relatively minor, all right, is relatively minor compared to the gain that we get, or the potential profit that we get by having a long position on a call, because of course if the stock ends up, for example, in here in this region, we collect a lot more than the price that we paid for it, and so it's a profitable trade. The same reasoning goes for puts. If we have a put on a stock that is very volatile, all right, the price goes like this, all right. Let's just say, for example, the strike price is the same, is 90. If the stock ends up right here, for example, at this level of price, for example, 110, all right, we will not sell for 90 a stock that is worth 110, right? Doesn't make any sense. And so the put will expire worthless. We lose, of course, the premium, but we don't get a much bigger loss by buying by selling for 90 something that is worth 110. But if the stock ends up around here, and let's just say, for example, that here the stock expires at 50, all right, we will be able to sell at 90 something that is worth 50. So we have a big profit, all right. So the reasoning is, with very volatile stocks, it's good to have long positions on options, because in the worst case scenario we lose the premium, but if we get a gain, we can have potentially a very large gain. And so that is why options are effectively a bet on volatility, all right. But why in this case, you may ask, if this provides such a large gain, such a large potential gain, why then are we selling options instead of buying them? And it is a very, very pertinent question to make, and the reason is because of this graph that I'm going to show you right now. So as you can see, this is the VIX. VIX is an index that displays the volatility of the stock market at a given point in time. And of course, when volatility is high, there is a lot of panic, a lot of mayhem in the market. Usually prices crash because there's a lot of fear. And usually when volatility is low, everything is calm. Normally, more often than not, the market is rising because investors are calm, are confident that everything is going to turn out all right. And so because of that, the stock market tends to rise when volatility is low. And so, as you can see, when, of course, we are talking about a time period which spans over 20 years. This goes all the way back until from April the 30th, 2004 until the present day, or the last business day at the time of recording this video, which is August 30th, 2024. And as you can see right here, over 20 years of data, volatility for the most part has been relatively subdued, has been relatively low. And so, as you can see in this graph, there has been really two large spikes in volatility, all right? This one is right here, around October, November 2008. Why is that? This was at the time of the Great Financial Crisis, when Lehman Brothers went bankrupt, and there were a lot of fears that its bankruptcy would drag the entire financial market or the entire financial sector in the United States along with it. And so there was a lot of panic in the market at that time, and because of that, the VIX, which is called also the panic index, went sky high into nearly 80, all right? And so there were also other sensitive points of a bit higher volatility here. For example, around 2010, this was at the time in which the sovereign debt crisis started to hit Europe, especially Greece, and of course then it would emanate to Italy, Spain, Portugal as well. And so this was also some of the time in which there was a lot of volatility in the market. Here as well, around 2011, this was also when countries, for example, like Portugal, asked for an international bailout to the IMF, so there was also a lot of fear in the market. and also Ireland as well was also in big trouble because of its financial sector as well, and also Iceland. And so these were also two significant spikes, but then the market went relatively calm until another event by around March 2020, which of course we all know that was when the COVID pandemic hit really hard and people were forced into lockdown. And so this was also a moment of panic in the market, where volatility was also very high. But as you can see, for the most part, over more than 20 years, volatility has been relatively low. And this shows us that in this case, since the markets are most of the time very with low volatility, it pays to be short on options, because when volatility is low, those kind of events that make long positions on calls profitable do not happen. All right, and so it makes much more profitable most of the time to be short on options. And just to illustrate this point a little bit better, let's just make this, of course, this will be for the call. All right, a short position on a call has this type of pattern. All right, here is the strike price. It doesn't matter at this point. All right, and this is the same graphic but for a put option, right? And so because of this, when we are short on options, we are basically betting that volatility will be low, as is most of the time, because when volatility is high, and of course these are inverse positions relative to the long positions, if a stock is constantly moving, all right, we may end up having a loss at this point. But if a stock is low volatility and the market is low, displays low volatility during the life of the option, chances are it will remain, because of course in this case, in this area are the out of the money options, all right, and in this area right here are out of the money puts, all right. And so as long as they stay in this area right here, and for the puts stay within this area, which is exactly what you want, the call and the put will expire worthless. We keep the entire premium and nothing will happen. We make the profit. And so this can only happen with low volatility, and that's why we want to use the wheel strategy on low volatility stocks, even though of course they offer a relatively lower premium, but in the long run this is the way to go. The wheel strategy, and of course selling options, is about making small gains but very consistently. Keep chipping away, keep getting small profits over and over and over again, but over time they compound, and so that's why in the long run the wheel is a successful strategy. Because and one detail that I forgot also to mention here, volatility tends to revert to the mean, tends to display mean reversion. As we know here, volatility tends to be on an average in 20 in the VIX, and so every single spike was very, very short term, very short lived, and the volatility tends to revert to its mean in the long run by around 20. So that is why selling options in the long run is more profitable than buying options. Now, another point to make in this explanation why the wheel strategy is successful is also because one particular factor, which is called the theta. For those who are less familiar with options, there are some key metrics which are used to characterize the relationship between an option and another variable, wherever it is. There are several, but in this case, the theta is it characterizes the relationship of the option with another particular variable, and the theta is one of the option Greeks. And just for me to explain this point a little bit better, let's just erase this. If you don't know what the option Greeks are, you can search online, but I'll give you the explanation here anyway. There are several. For example, let's just put here a bullet. For example, the delta, which explains the relationship between the stock price, all right, so, and the option price, all right. And so, for example, how much I might as well put it the other way around, but let's just say option price and the stock price. It's better to explain this way. For example, it says, all right, how much the option price moves when the underlying asset, which is in this case the stock price, moves 1% or $1, for example, but in this case is usually 1%. All right. We also have the gamma, which tells how much the delta moves. So this is sort of a second order effect, all right, because it's based on the delta, which is in itself another variable. How much the delta moves, all right, when the stock price moves 1%. Now, when I say moves, it could be up or could be down, all right? It's the same thing. So another one, for example, which is the Vega, it tells us how much the option price, when I say option price is always a premium, all right, how much your option price moves when the volatility of the stock changes 1%, right? And this there are other ones, for example the raw, but the raw is the same thing but for interest rates. So but in here is not relevant how much the option price moves for a change in 1% or 1 percentage point in the interest rates. But what we want to really know here, and the important variable for us to talk, is the theta, which says how much of the option price moves with the passage of time, all right? And so this is important, and you'll see why. Let's put another slide in here, all right? And why the theta is important. The theta, let me just erase this box here. And so the theta says that it displays several characteristics. Why is that? The theta is always negative for the option buyer, all right? Why is that? Because, as we know, options as time passes, all right, as time passes, options lose their time value, all right? And so the more the time passes, the value of the option, which is composed by time value and intrinsic value, time value, which is the value given by the time remaining to maturity, and intrinsic value, which says that, all right, the value is the difference, the intrinsic value is the difference between the stock price and the strike price, all right? And so when it reaches maturity, time value is 0, and it only has intrinsic value, which can be 0 or positive. All right, and so since that is always negative for option buyer, so it is always positive for the option seller, and this is very, very important. Why is that? Because you buy, if you are the option buyer, you buy a stock, you buy an option, all right, and you have the hope of buying at a low price, and either sell at a high price or exercise it at a profit. All right, but for the option seller, what is his purpose? The purpose is to sell at a high price and either buy back at a low price or let it down to 0 when at maturity, when it expires worthless. All right, and so this is why the theta is an important factor for the option seller. All right, because as I mentioned, as time passes, the options lose their time value and only the intrinsic value remains. Intrinsic value, as I mentioned, is stock price minus strike price for calls and option price, strike price minus stock price for puts, right? And the behavior of theta, and this is something very, very interesting, all right? The theta displays this pattern. It goes like this. Let's just assume here it's time to maturity. All right, time to maturity. Right. Gosh, I wish I could use the mouse better to write this better, but whatever. This is the time to maturity, and the theta displays this pattern. It goes down, 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 and let's just assume that the time to maturity is here, all right, at this point in time, and it goes down, 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 and when it's close to maturity, it decreases at a very, very fast rate, all right, so it goes crashing down. And this is why me as an options trader, I like to use only weekly options, all right? Even though, let's just say, for example, let's just say, for example, at this point, it's 1 week until maturity. Here is, let's just say, 1 month. And let's just say, for example, here is 6 months, all right? Doesn't matter. So if I sell a 6-month option, of course, there is a lot of time value in it, all right? But it takes also a long time for to be able to profit from that large time value, all right? And so if I sell a weekly option, I will spend most of the time committed with the option when the theta decreases at a very, very fast rate. in this section right here. All right, and so this section is where I'm most interested in selling options, because I'm selling an option which, of course, being 1 week away from maturity, it has relatively reduced time value, but the time value goes away very, very, very fast. And so all of this is value that is reflected in the option premium, but it goes away at a very, very fast rate. And so the option will lose value quickly, and I will be able to profit most of the time from the decrease in time value. All right, but of course the price which is pocketed by me when I sell the option, so at this particular moment in time, and of course I sold something which loses value much quicker. Of course, we are not talking about what happens to the intrinsic value. That depends on the moves of the stock price, but this component of the option price is at least it works always in our favor, and in the case of 1 week options, it works in our favor in a very, very favorable way. All right, and this is something that makes me more inclined to use and to focus only on 1 week options. All right, and of course, if the trade goes either against me, I can buy back at a lower price, usually, or at least with a much reduced time value. And also, if the stock price or the component of the intrinsic value goes very much in my favor, so also towards zero, I will be able to quickly buy back the option at a value at almost zero and close the trade right there and roll over the trade to pocket another premium on another option. And so that is why, for me, I think that the most favorable way to profit from this strategy is just selling weekly options, which is of course the shortest maturity you usually get. And so this is also another reason why I think this is a profitable strategy. And finally, there is also a subtle detail which I want you to keep in mind, which is an interesting one, because technically you start by selling puts on this strategy starts by selling puts, but if the stock is assigned to you and you have to buy it, then you sell calls on the stock. But as we will see, and I will show you that, you are doing basically the same thing. You are selling puts at every step of the wheel strategy. And why is that? I will show you. So this is the step one. All right, step one. You have money available, so this money will be used as collateral for you to sell puts on a particular stock. And so a put has this pattern. This is the strike price, all right? This is the strike price. And you sell puts on an option, all right? On a stock. And it goes like this. You continue as long as the price stays in here. You will continue to pocket the premium, selling puts and puts and puts and puts until finally the stock price goes below the strike, goes here or whatever it may be, and you have to buy the stock. All right, and now you are going to sell calls on the stock because you already have the stock. All right, and so instead of money as a collateral, you will use the stock as collateral to sell calls on it. But what you are in fact doing is selling another put. And why is that? The pattern of a stock, let's just say that, for example, I had the put was assigned and the strike price was 100, right? This is 100. And so I bought the stock at 100, even though it was worth 95 or whatever, doesn't matter. And so basically, this is the pattern of a stock. This is a stock. All right. This is a stock. And it crosses here this line, which is the line of the strike, right? But doesn't really matter. That is for stocks. And so here is 100, right? Because I bought the stock for 100, and so if I sell the stock for 100 right here, I break even. So my profit is 0, because here is a profit. All right, profit. And so my profit here is 0. But if I want to break even, I will sell a call with a strike price of 100. So if the stock exceeds 100, I will sell the stock at 100. And so this is the pattern of a call option with a strike of 100, right? And this is, of course, the call, the short call, right? The short position on a call. Short. Now, why do I say that this is in fact a put, or in this case a short position on a put? Because, and I will open another window in here, but I'm going to do an overlay just to show you this. I'm going to basically reproduce this setup in another way. As you can see here, we have the payoff of the call in here is horizontal, so it's flat, all right? But here, as we move from a price of 0 towards 100, all right, what is our payoff? The payoff rises because the stock rises and the payoff of the call is flat, is even in here. So here it rises, but it's still negative, all right, because here we are in the loss, and this loss is greater than this profit right here. So we are at this point, yeah, like this, all right. And of course here we have the stock entering in positive territory, which is this section right here. And then once it reaches 100, what happens? The stock rises. If the stock price rises, the pattern continues to rise for the stock, but as we move past 100, the call starts to lose. And so when we have this losing pattern on the call and this winning pattern on the stock, it goes flat, it goes even, because the gains of the stock are offset by the losses on the call. Basically, by selling a call on 100 with the strike on 100, you cap the gains on 100. You cannot gain anything more than the stock price being 100. And so basically you have, as you see right here, you have the pattern of a short put. This is the same we had in here, all right? The same thing. Of course, in this case, don't consider this pattern here, because of course this is just a drawing, it doesn't matter. But as long as we are below 100, the stock, but the stock price rises, this pattern of the stock rises, here stay flat. So here the combining pattern is to rise, but then once we reach 100, the stock price continues to rise, but the pattern of the call is to go lower. So the call starts to lose money, and so the gains of the stock are offset by the losses in the call. and so that's why we tend to have this even pattern, because we cannot go in terms of profit. This is where we maximize our profit, and this is also where we maximize our profit. And so basically what this position is, all right, this position here on the right, this is what we call, and let's just forget about this, a synthetic, let's just see if I don't run out of space, a synthetic there should be an H in here, but whatever. This is a synthetic short put, right? This is a synthetic short put. This is a real short put, right? Because we simply sold a put, right? But this is a real short put, but here on the right we have a synthetic short put. We created the short put by using a stock and or in this case a long position on a stock, we hold a stock, and a short call. And so basically the wheel strategy, it goes over and over again by selling first and foremost a real put, so you having a short put position, and then once the stock is assigned you basically create a short put again, but instead of having the money as a collateral you have the stock, and so you use the stock to create a synthetic short put position. And basically this is what I wanted to show you, and these are, I think these are for the most part all the reasons why it is a successful strategy, the wheel. And I believe that, I'm a strong believer that this strategy, because markets are low volatility, have low volatility for most of the time, and as the option seller we get the premium, and the premium include a risk premium because we are providing insurance to the option buyer, and also because that makes it options intrinsically expensive, all right, because we have to compensate the seller for providing insurance on the buyer, and also the factor of the theta, which is also extremely important, because the theta at the end of the day, since it's always positive for the option seller, it is a factor which is whatever happens to the stock price, whatever happens, the theta or the passage of time will always work in your favor regardless of what happened. And so this is a detail, a factor which will always work in your favor, and so it also pushes you towards being more successful when you sell options instead of buying them. But this is it. This is what I wanted to show you. I can understand that this video may raise a lot of questions, some doubts, of course, but feel free to share them in the comments. You can also reach out to me on LinkedIn and ask me further questions. I will be more than happy to answer you and to, of course, make things as clear for you as I can possibly do. And of course, don't forget to like the video and subscribe to the channel, and stay in touch, because we will continue to move forward with our wheel strategy in our challenge, in our road to 200k challenge. And yeah, this is it, and I'll see you all on the next one.